Welcome back, students who are taking financial accounting, and in this series of videos we are working on the chapter 4 assigned exercises from group B that were assigned in the digital study guide. And we are working, we finished off in the last video with 4-26, so now we're on 4-27. And as always, if you don't understand something, most likely it's the theory, so go back and rewatch the theory videos, and if you still don't understand something, feel free to telephone or contact an instructor. All right, so let's do 4-27B here. All right, it says here, journalize the following transactions that occur during the month of December. Okay, so on December 3rd, they purchased 7,300 of merchandise on account with terms of 210 net 30 FOB shipping point. The supplier prepaid freight charges of $475 and added the amount to the invoice. Okay. And let's see, December 6th, returned damaged goods to the supplier and received a credit memorandum in the amount of $12.50. And then number 12, paid for the goods purchased on December 3rd. This is very similar to exercise 4-26B. Okay, it just in 4-26B, they gave you all this information in this paragraph format. Now they're just giving you basically kind of the same information but by date here. So go back and watch 4-26B. And for a more detailed detailed explanation of how I'm making those journal entries. I'm not going to spend as much time on 4-27 because that explanation is in 4-26. Right, so let's get started here. First of all, if I create a timeline here, because I'm dealing with terms, so on 12/3, there's a purchase of $7,300 for merchandise, and the terms are 2% 10. So 10 days from 12/23 is 12/13. FOB shipping point, and the prepaid freight charges are added to the amount of the invoice, so that's an additional $475 for shipping. So the invoice is going to end up being $7,775. Okay, on 12/6, damaged goods are returned to the supplier and a credit of $12,250. And then on 12/12, the invoice was paid, but notice that's within the discount period, so we're going to have to calculate the discount. So for our journal entries on 12/3, if I'm purchasing 7,300 of merchandise on account, right? So when making a journal entry, I ask myself, am I affecting cash? And the answer to that is no, because it's on account. So then I ask myself, does that affect accounts receivable or accounts payable? And the answer to that is yes, because I'm purchasing on account, so that's an accounts payable. And accounts payable is a liability. The normal balance of a liability, meaning what increases the liability, is a credit. So that means I'm going to credit my accounts payable, and the amount I'm going to credit it is the $7,775. Debits have to equal credits, so what am I buying? I'm buying merchandise, which is inventory. So I debit inventory for $77.75. And on 12/6, it says I'm returning damaged goods to the supplier and receiving a credit memorandum in the amount of $12.50. Well, remember, if it's a credit memo, all we're doing is we're just reversing the original entry in proportion to whatever we're returning. So if I have since I write my debits before I write my credits, I look at my credit to accounts payable, so that becomes a debit to accounts payable in the amount of $12.50. And I'm going to credit my inventory for $12.50. Okay, now for 12, the entry for 12/12, right? Let's see here. How much is actually going to be paid? All right. Well, if I had $7,775 and there was a credit of $1,250, okay, then that means my accounts payable here, it's 5 to 5, 65.25. So I have to, if I drew the T account for accounts payable, I had 77.75 in my credit, and then I debited 12.50, right? So in order to wash out my accounts payable, I have to actually debit accounts payable for 65.25 in order to make the balance in that account 0. So I'm going to debit accounts payable for 65.25, okay? But that's my accounts payable. What am I going to pay in cash? Well, in cash, I have a 2% discount because I'm paying it within 10 days. So how do I calculate my discount? To calculate my discount, I take what my original purchase was of $7,300. Now we're taking that. We're not using the $77.75 because remember, that includes the shipping, and we can't take discounts on shipping. So we take our original purchase price of $7,300, then we have to subtract out what was returned, right? So that's that's $60.50, and then we multiply that by the 2%. And when we multiply that by the 2%, that gives me, let's see here, $121. So my discount is going to be $121, right? If I'm paying, now I'm going to erase some of this stuff here. And I don't need the accounts payable stuff here, so I can get rid of that. Right, so if my accounts payable is $65.25 and I'm able to take a $121 discount, right? That means in cash I'm going to pay $64.04. Okay, so I'm going to have a credit to my cash for $64.04. Okay, and then I have a credit to my inventory for the $121 of discount. So, for that particular entry, and let me just draw a line here. Okay, so for this entry, my debits equal those two credits, right? And that's how I get my journal entry to balance, right? And that's it for that particular problem. Right, next one, 28. On November 14th, Salem Food Wholesale sold 2,700 of inventory on account to one of its customers. The cost was $1,050. The terms were 3% 10, net 30, FOB destination. FOB destination. On November 16th, they paid freight charges of $195 related to delivery of the goods sold on November 14th. On November 20th, 300 goods were returned by the customer with a cost of $1,115. And on November 23rd, Salem Foods received payment in full from the customer. Okay, so I just got done working through 4-27, and I had referred back to 4-26. Okay, remember, just like accounts receivable, and accounts payable, they're two sides to the same coin. Okay, well, when you make sales, that's the same, two sides of the same coin as if you're making purchases. Okay. The only difference is that with the sales, whenever you make a sale, you also have to consider that what are you selling? You have to take some, if you're selling your inventory, you have to take it out and move it over to cost of goods sold. So whenever you make whenever you make a sale, you also have to make a journal entry in order to deal with your inventory, whereas in purchases you don't. Okay, but otherwise, it's basically all, it's the same, two sides of the same coin. So if you know how to do one, you know how to do the other. And that's why I suggest that you look at problem 4-26 and you look at 4-27 in order to get the theory. And then of course in this one, you apply that same thinking here. Okay, so just realize that you're talking about two sides to the same coin. And if you know how to do one, associate with the other. All right. So let's draw a timeline here. And since we're making, we're selling, all right, we're talking about an accounts receivable here. Whereas in 4-27, we're talking about purchases, which was an accounts payable. So on November 14th, we're selling $2,700 of inventory that has a cost of $1,050. And we're doing that on account, remember, accounts receivable. The terms were 3% 10, so 10 days from 11/14 is 11/24. And it's FOB destination. On November 16th, 11/16, they paid the freight charges of $195 related to the delivery of the goods sold on November 14th. Now, we have to pay attention to this FOB destination, right? Because who's paying the ship, who's paying for the freight? Well, if it's FOB destination, that means the Salem Food Wholesale is the one who's paying it, okay? And we're talking about two sides to the same coin, and if you've been watching these videos, you had seen that when I had said if we're buying an item for inventory, we have to put all of the associated costs with that inventory, with that product. So whatever we buy for inventory, we're going to include our shipping and handling, or our freight charges, and our tax as to the dollar amount for that inventory that we're going, whatever that totals up to as the cost of that item in inventory. But when we're selling, this was, when we have shipping and handling and we're taking it in, okay, it's part of the cost of that particular product. And then when we go to sell it, all right, that becomes part of our cost of goods sold. But if we have to ship it, all right, and in this case here, FOB destination means we're shipping and we're paying for it, well, then that actually becomes an expense to us, because that's a normal part of the operation of the business, us selling that particular product. All right, it's not part of the cost of goods sold. The shipping that we pay if we're buying goes as a part of the cost of inventory, and then when we sell it, that whole cost goes to the cost of goods sold. But when we sell it, if we have an additional shipping charge that we have to pay, that becomes an expense to us. So that, you would see that as maybe shipping and handling expense, or freight expense, or delivery expense. It all just depends upon how you want to name that account. But the point being is that as the normal operation of our business, and what's the operation of our business? We're selling a product or service, and that's our revenue, and we have to match that up with our expenses, right? And part of our expenses when we sell that product is if we have to ship it, that's an expense to us. So don't think that when you're looking at FOB destination and there's a freight charge there, that's part of the cost of the inventory. It isn't. All right. So rewind these last few minutes, these last, say, 5 or 6 minutes, and go over that again, okay, if you don't understand it fully, okay. You know, it's just a matter of when we buy something and it's for inventory, the shipping gets associated with the inventory. But when we go to sell it to another customer as part of the operation of our business, if there's an additional shipping charge, that is an expense to the business. It doesn't get associated with the inventory. Okay. Right, so on November 16th, paid freight charges of $195 related to delivery sold on November 14th. On November 20th, $300 of goods were returned, so $300 was returned by the customer. And on November 23rd, say we're looking at November 23rd, that received payment, so it's paid, but that falls within the discount period, so we have to consider a discount there. So let's work through these journal entries. Okay. All right, so first, let me erase this so I can read it. All right, so on November 14th, we sell $2,700 of inventory on account. Okay, so we're going to, if it's on account, right, that's accounts receivable. That means we're going to debit accounts receivable for the $2,700, and we're going to credit our revenue account, sales revenue, for $2,700. And because we make the sale, and we're, you know, the item is no longer in inventory, so we have to move that item out of inventory. Okay, and since inventory is an asset, right? Inventory is an asset, and our assets are, the normal balance is a debit, meaning we increase assets on the debit side. Well, if we're taking that out of inventory, that means we need to credit our inventory for the cost of $1,050, and we have to debit something else. So that goes to our cost of goods sold, which is our expense account when we move our inventory, when we take it out of inventory. Okay. So that's the journal entry for the sale on November 14th. Now, it says here the terms were, okay, on November 16th, right, we paid freight charges related to the delivery of the goods. So on November 16th, you know, we're paying freight charges. Well, are we affecting cash? Yes. Okay, is our cash increasing or decreasing? Decreasing, so we credit our cash for the $195, and we have to debit something else. And this is where, if you're thinking through the process of making journal entries, you think about the category of accounts first, right? Because what am I doing? I'm paying freight. Well, is that an asset? Well, yeah, we're selling, you know, we sold the product out of inventory, but this is the freight aspect of it. Okay, you know, it's not an asset. It's certainly not a liability or equity, and certainly not revenue, so it has to be an expense, right? Because we are paying the freight. So we look at our expense accounts, and in this case here, you know, they're using, excuse me, they're using delivery expense for $195. Okay, that could have been shipping and handling expense or freight expense or whatever. It just depends upon what was on your chart of accounts. But when you go into a new business, and until you become familiar with that chart, think about the categories, and you look under expenses, and then you choose the most appropriate account, you know, for that expense. So that's the entry for November 16th. Now, I don't have enough space here, so pause the video and write that down if you have to. Okay, and I'm going to erase all of this in order to continue on. Okay, so so we're up to November 20th, and on November 20th, $300 of goods with a cost of $115 were returned by the customer. Okay, well, we should be accustomed to this. All right, why? because if $300 of goods are being returned, you know, we were on November 14th, we billed, okay, follow along here in the thinking of the process. Am I affecting cash? No. Am I affecting accounts payable or accounts receivable? Yes. Why? Because I affected my accounts receivable because I, from November 14th, I billed $2,700 to my accounts receivable. Now $300 of goods are being returned. So that means I have to credit my accounts receivable for $300 and I have to debit something else. Well, what am I going to debit? Well, what was part of that entry? Part of that, the reversal of that entry, remember the original entry was a debit to accounts receivable and a credit to sales revenue. But we're not, normally we reverse the entry, but we're not going to use the revenue account because we want to track our returns and allowances. So we're going to debit our sales returns and allowance account for $300. Right? This way we know how much we sold and how much it was actually returned. And of course, since we're getting a return and we're affecting our sales, that's going to affect our inventory. So we have to reverse, our original inventory, our journal entry for the inventory. Remember, we debited cost of goods sold and we had credited inventory. Well, now we're going, because we took it out, now we have to put it back in. So we're going to debit inventory for the cost of $115, and we're going to credit the cost of goods sold for $115. Okay, so that's our entry for 11/20. And yeah, I'm just using this one screen, but a word to the wise, if you had a separate sheet of paper, I would be making T accounts, and as I'm going through and putting those amounts in order to be able to figure out what it is you're doing, and you can readily see, what effects that you have. Okay. All right, so I'm going to erase this 11/20 entry. And now we're on 11/23 where we're paying the bill. Okay, so what are we paying here? Well, first of all, we're looking at our accounts receivable. Remember, our accounts receivable here had a debit of $2,700 and a credit of $300. So we have to credit accounts receivable for $2,400. Right? We also says, that they're receiving payment in full and it falls within the discount period. Okay. Well, what's our discount? Okay. If we sold $2,700 worth of stuff, $300 was returned, right? That's $2,400. And we get a 3% discount on that. So we multiply that by 3%. And that gives us, let's see, $72, all right? So we will end up debiting sales discount for $72. Just like we're using the return and allowance, we use the sales discount account. Thought just popped into my mind. When we have our sales and our purchases, we will have the sales discount and the sales return and allowance contra accounts, and we can have the same thing for our purchases. We can have purchase discounts and purchase returns and allowances. Whether a company actually decides to use the discount and return and allowance account, that's up to them. Okay. They have more of a tendency to use them for sales, to be able to track their sales. But when it comes to purchases, it's a 50-50 kind of thing. A lot of times, I just want to know what the bottom line of whatever I paid for something. I don't need to track my, discounts and stuff like that, or my returns and allowances. but they do have a tendency to pay a lot more attention to the sales aspect of it. So that's just a little quick FYI. In the real world, you'll see the use of discounts and returns allowances on the sales side more than you'll see it on the purchase side. Okay. All right, so I need to have my debits equal my credits, so I have to debit something else here. And what am I going to debit? Well, I'm going to debit my cash because I'm paying the invoice in full. You know, I could take the $2,400 and multiply that by 97%, right? 3% discount from 100 is 97%, and end up with 2328, and that's my debit to cash. Or I could have just taken the 2400 and then subtracted the 72 and got 2328, which is probably what I would have done. I wouldn't have done this extra step right here. I wouldn't have done this for the cash. But in either case, you're going to end up with your cash being 2328 because debits have to equal credits. Okay, so that's it for this problem. Again, you know, 4-26, 27, and now 28 will give you, you're watching all of those, it'll give you a basic understanding of the process, but as you go from one to the next, you know, and that's where the understanding and application comes in. If you're understanding the process, you'll see that the application gets tweaked every time. There's a little bit different here, there's a little bit different there, and that's why you're not going to find one example in the book that covers every situation that you possibly can have. You know, every situation is unique and different. I can go on and create another 5 more problems that are different from this, building one upon the other with a little tweak here and a little tweak there. But the whole idea is still the same, okay? Going through the process is still the same. It's just a matter of tweaking them, okay? That information, that's why it's important to understand the concepts. Then the application becomes easy, right? But if you don't understand the concepts, you need to go back and watch the previous videos, think through it, and then if you still don't understand something, you know, call and speak with an instructor, okay? So I'll see you in the next video for 4-29.